All right, so is the Roth IRA better than the traditional IRA? Well, according to Dave Ramsey, it is.
And so the Roth absolutely mathematically kicks the traditional's butt.
And that may be true for many people, but you are about to find out why that is not always the case. Just listen to this clip from Zach Call.
Well, if you have a high tax rate today and you have to pay 30% tax on any earned income, but you're going to retire and it's going to drop to 12, there's an 18% tax difference between those two.
Now, I can personally attest to this as a licensed CPA. There is truly not a one-size-fits-all approach to this topic. And if you are not careful, you could end up paying way more money in taxes by simply choosing the wrong account type. The account type you should pick should be based on things like your current tax rate, your expected tax rate at retirement, and your financial goals. And that will be different for every single person watching this video. But the information that I'm about to provide you with will help you determine which of these options may be best for you. I personally use these accounts to reduce my own taxes, and I advise my clients on this exact topic all the time at mycpacoach.com, which saves them tens of thousands of dollars in taxes. So go ahead and do yourself a favor and save this video, comment any feedback and questions you have below, and be sure to subscribe for more content that can help you put some more money in your pockets. All right, so let's warm up here by discussing why people use these accounts in the very first place. So first of all, nearly half of American households have no retirement savings at all, like zero. And many others do not have nearly enough saved to actually live off of during their retirement. Then on top of that, Social Security is not enough for a comfortable retirement for most people, and the future of the program is uncertain. Now, the single best solution to this problem is for people to put their retirement savings into their own hands by simply putting a portion of their income aside for it. And the government wants you to do this as well, which is why they give out massive tax benefits to people who save through individual retirement accounts, also known as IRAs. The IRA tax benefits are so massive that people who are not even thinking about retirement are setting these accounts up just to save money in taxes alone. Now, there are two types of IRAs, the traditional IRA and the Roth IRA. Now, the type you select here will single-handedly determine the tax benefits you will receive. So let's address the key characteristics of these accounts, and then we will talk about who these accounts are typically best for. Now, both of these accounts allow you to put money aside for retirement, invest the money into other assets, and withdraw funds at retirement age. But the difference between them is what happens from a tax perspective when you do these different things. So let's start by looking at the traditional IRA. What you need to know about the traditional IRA is that it is funded with pre-tax dollars. You are putting income that has not been taxed into your retirement account. In other words, every dollar you contribute to a traditional IRA is a dollar deducted from your taxable income that year. And since taxes are based on your income, you end up paying less taxes at that time. For example, if you made $10,000 in income and you put $7,000 into your traditional IRA, you would only pay tax on the remaining $3,000 in income. Then you can invest those funds into various assets like stocks, bonds, or even private real estate and small businesses if you use a self-directed IRA. Now, as your traditional IRA balance appreciates in value, you pay no taxes. All taxes are deferred until you start taking withdrawals at a later date. So let's say you max out your traditional IRA every year, and now you have a $1 million balance when you retire. And at that time, you withdraw $50,000 in 1 year. Well, that $50,000 withdrawal will be taxed as ordinary income. The moment you withdraw funds from a traditional IRA, you create a taxable event. Now, most people try to make these withdrawals during years where they are in very low tax brackets. And if they just so happen to be in a very high tax bracket, then they are probably already earning enough income and can refrain from making any withdrawals from their traditional IRA. But eventually, the IRS does force you to start taking distributions. Once you turn 73 years of age, the IRS requires you to take something called required minimum distributions, which basically forces you to withdraw a certain amount and will trigger taxes that you will have to pay. Though still, a traditional IRA may be more valuable than a Roth depending on your circumstances. And I'll explain those circumstances in a moment. But let's first make sure you understand the power of the Roth. Now, for most people, a Roth IRA is actually more beneficial than a traditional IRA. There are no required minimum distributions. You don't have to wait until retirement age to withdraw your principal, and you can withdraw your earnings tax-free once you reach retirement age. So here's how it works. First of all, when you put money into a Roth IRA, you do not receive a tax deduction in the year you made the contribution. A Roth is funded with after-tax dollars, so the money you put in it will not reduce your taxes on your paycheck or the income on your tax return like a traditional IRA. So if we use the same example as before, if you made $10,000 in income, put $7,000 into your Roth, you would still pay tax on $10,000 in income. But if your Roth appreciates to millions of dollars by the time you retire, you will be able to withdraw all of those earnings tax-free. You simply do not have to worry about any taxes related to your retirement balance, which creates a level of simplicity and peace of mind for most people. So with a Roth, you will never pay tax on any income generated inside of your account. You should never pay tax when you withdraw money from your account, as long as you do it correctly. And 3, you will never have to take required minimum distributions while you are alive. This is all because you paid Uncle Sam up front. So just remember, with a Roth, you pay income tax up front, but no taxes later when you start making withdrawals. With a traditional IRA, you pay no income tax initially, but you do pay tax when you start making those withdrawals later. They work completely inverse of each other. So which of these accounts are best and for who? Let's go over some general best practices here. So when it comes to choosing between a traditional IRA and a Roth, you should choose the best option based on your current tax rate, expected tax rate, and financial goals, like I said earlier. A Roth IRA saves you money when you are in a lower tax bracket today than you will be in during your retirement. And a traditional IRA saves you money in taxes when you are in a higher tax bracket today than you will be in retirement. Keep in mind that tax brackets generally rise over time, so you should be in a high tax bracket to justify using a traditional IRA over a Roth. Now, to get an idea, look at this table and find out what tax bracket your income falls within. If you are in the 32 to 37% tax bracket today, and you expect to be in the 10 to 22% tax bracket during retirement, a traditional IRA could save you anywhere between 10 to 27% in federal income taxes alone. When your tax bracket is north of 30%, most advisors would say that the traditional IRA is the better option compared to a Roth. But on the other hand, if your tax bracket is in the 10 to 20% range, the Roth IRA can be more beneficial long term. You can pay your tax and get it out of the way and enjoy the tax-free wealth on your earnings without worrying about the future of tax rates. But here's another very important thing to consider. Life happens. Your personal tax bracket is rarely constant, and you may find it best to contribute to either one of these accounts or both based on the circumstances at that time. To illustrate, take a look at this neat chart from Kitsis.com. It shows how your tax rate can change as you go through life. Income and tax brackets are typically not constant over someone's entire life, and there are various events that may increase or decrease it at any given time, from getting married, starting a business, going through health challenges, or eventually retiring. And you can rotate how you move money to a traditional IRA or Roth IRA based on your income in any given year. As you can see here, a traditional IRA is recommended when your tax bracket is north of 30%, and then it's a toss-up when you're in the 20 to 30% range, in which you could hypothetically contribute to both accounts 50-50. And then finally, as you can see, a Roth IRA is typically recommended in the 15% and below tax bracket range. So ultimately, the best strategy may be to use a combination of a traditional and Roth IRA. This will give you the best of both worlds. The Roth will give you a 100% tax-free nest egg since you've already paid tax on the income that went into it, And the traditional may allow you to take advantage of low tax brackets during your lower income years during retirement. For example, if you are in a 12% tax bracket, you may choose to withdraw money from your traditional IRA to realize that tax at a time when your taxes will be low during your retirement. And this may be a lower tax rate than what you would pay under the Roth strategy, where you pay taxes upfront during your highest earning years, income-wise. Anyway, if you found this guide helpful, please be sure to like the video. And if you want a plan that is guaranteed to reduce your taxes, apply to work with one of my CPAs today at mycpacoach.com.